Hey guys, welcome to Elite Acquisitions and Investment Banking, your number one M&A podcast. And we're here with Mark Biersmith, who's an MBA, CPA, CMA, CCP, CGMA. Hey Mark, glad to have you on this episode.
Thank you very much.
Appreciate it, Mark. Appreciate you being here.
My
And
pleasure.
as you already know, Ansi Monsione. So I got a couple questions I want to run through you, Mark.
Please.
Touching on your area of expertise, and then we can move on from there. First question. Now, a little introductory. We focus on lower middle market companies. We're talking about $1 to $10 million, right? That's our starting range. That's usually the range we see a lot of the people involved. Now, as you know, larger businesses and smaller businesses are valued differently. So starting on that topic, we want to talk about what's the best cash flow metric to use. Would it be EBITDA? Would it be NOPAT? Free cash flow? Discounted cash flow? You tell us, Mark.
Okay, so let's get us all on the same page, if I may.
Right.
And I will tell your audience that at the end I'll give you my contact information, or I'll give it during the broadcast. But first of all, let's get us all on the same page. So what we're talking about with private companies is that enterprise value is equal to EBITDA times market multiple. Most people would say adjusted EBITDA times market multiple. Okay. Now, so the major measurement traditionally has been adjusted EBITDA. Adjusted is essentially non-recurring adjustments in the year under evaluation. So when we talk about large and small companies and they're being valued differently, there's 2 points to make. Number one, the market multiple goes up as liquidity goes up. Okay, so if you're a private company and you have to go through the normal transactional process, liquidity takes a while, right? So the market multiple tends to be diluted compared to a public company, which goes through a different evaluation technique because it's very liquid and therefore has a higher multiple. Not always, but traditionally. So essentially there are two things to be concerned about. Number one, you often hear people value things on revenue, okay? And a finance person and a buyer should never look at that number and do their evaluation as to what they should be paid. We understand it, but it's kind of the lazy person's way, and it's a good way to get in trouble, because at the ultimate decision maker of what the company is worth is how you can finance it, right? So let's just use an example. Let's assume there's a market multiple of 7 times adjusted EBITDA, okay? So the market multiple at 7 would bring out about a 3.5 times debt availability. So then that means you got 3.5 times you got to come up with equity. Okay. So it's really about valuation and then financing. And then the buyer ultimately wants to know what the ROI is. The ROI will be found in the discounted cash flow approach. Okay. But when you're talking about valuation of a private company, traditionally you're looking at adjusted EBITDA.
Mark, let me ask you, just to get your permission, you don't mind going in depth?
I do not, sir.
Okay, because I want to go back and forth on this.
Please.
Now, you said EBITDA, adjusted EBITDA. One thing I've noticed myself analyzing these smaller businesses, you got the investment banker approach, the CPA approach, which is coming up with a valuation, right? Then our approach as a buyer, we're taking into consideration how much we can finance, because we're using OPM, other people's money, say for the major part, bank financing. And the banks are concerned about the debt to service ratio. Now, I pulled this article, which I resonate a lot with, from Axio, which is a lower middle market investment company, lower middle market firm. And they had this article, and it's titled Business Valuation Misconceptions. I want to run these through you and get your insights. First one says businesses are valued on multiples of EBITDA. They say this is a common misconception. Businesses are valued on free cash flow, discounted for the risk of the business. Free cash flow includes deduction for taxes, capital expenses, and owner's salary. Why? Because we're not being an owner operator. Many business sellers and brokers who do not understand business valuation often mistakenly say the business is valued on an industry standard multiple of EBITDA or SDE. Try telling that to a bank. The only number that matters is free cash flow. What's your insights on that?
Okay, so you have this concept of who you're talking to, right? Like, for instance, when the newspaper business was alive, they often said that the newspaper had to be written to a fifth grader so that they understand it.
Right.
If you walk into a CEO's office and had that comment, they're probably not going to let you finish your sentence, because to them, it's either a multiplier of revenue or it's a multiplier of adjusted EBITDA. Okay. It is true that the difference between financing a valuation and valuating the company is a problem, is a difference. So, the other misconception here that I just want to drive into is it's not like valuation is an arbitrary number. There are ways to back up the valuation. There are publications that go out with thousands of transactions in your industry that can properly give you the market multiple and the valuation of your business. So the value of the business, I'm not sure I agree with the article, frankly, because the value and whether you can afford to pay for it is two different questions. It truly is.
Right.
Everybody's borrowing power is different. Okay.
Right.
So when you speak of free cash flow, what you're really talking about is a subtraction for CapEx needs too, right? So I think that, yes, a bank cares about free cash because that tells them the risk of the senior debt. But at the end of the day, the CEO is either going to do a revenue multiple or an adjusted EBITDA multiple.
Right. Now, let me circle on that. My experience dealing with these business owners is that for the most part, they don't understand how the business valuation comes to and all those approaches. Dealing with business brokers, I've seen they overvalue the business. I run the numbers and it makes no sense. Now, let me break it down to you. Let's talk about EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, amortization, correct?
That is correct. If I can address the overvaluation, though,
Yes.
it is very simple. If you go to the published transactions in the industry that you're in, they're all there, or the ones that have been reported. And so what business brokers or what the seller is doing, and I've seen this happen in transactions that I've represented, is they fool with those transactions to get the number they want.
Right.
Okay. So if you want to know if the seller is overvaluing, some would call it cheating, you would simply go to that transactional listing. And this has actually happened in a meeting. Mm-hmm. And you can tell what transactions they took out to come up with the number they wanted.
Right. Now, a lot of these business owners I speak with ask, how did you come up with this valuation? Let me give you a crazy example. A guy was doing $350,000 net income, about $600,000 EBITDA, and he was asking for $5 million.
Okay, so
and he wanted it up front, which gave a very high multiple.
Okay. It's very simple. I think that when you go in with your presentation and you develop how it's like a lawyer, right? I like to use the example. There was this famous dinner in our history of the world. Some people believe it happened, some don't. But there were 12 people there. 11 of them took things on faith, right? And one of them walked in with evidence. He had to touch and feel before he believed.
Right.
When you walk into a presentation like that, you want to make sure you can sell the doubtful Thomas. Because if you get him, you got the rest. So when you walk into a CEO's office who's selling the business and you show them all this evidence and data, it's very hard to dispute. Now, usually the dispute is over adjustments to EBITDA. Okay?
I see.
And the definition for our audience is that an adjusted number has to be a non-recurring event. It is true that the seller is going to throw all kinds of things up against the wall in the adjustments, but technically it comes down to a non-recurring event.
Right. Now, I've noticed from what I've heard, investors close on about 1 out of 100 deals. Private equity more. Why is that? What's a major thing you see?
Well, first of all, I think that's kind of high. The rule in private equity that nobody talks about is that 2 out of 10 deals kind of make it. That pay for the. That's why the ROI is north of 35% in trying to get to deals, and if they're risky, it's 43. So, I personally, if it's 1 out of 100, to me, the analyst at the PE firm isn't narrowing the gap to deals that should be analyzed. But my ratio is 1 out of 10.
1 out of 10. I see.
Yes.
Now, talking about small businesses, your mom and pop shop, these are not analyzed financials. These are not analyzed by an accounting firm. It's just what they put on the documents. Now, somebody told me the best way you could get the true numbers is by getting the bank statements and then verifying.
Okay. A couple of points. First of all, there's break-even points in the M&A world, right? So there's a point where the transactional cost doesn't make the deal worth looking at. Right. So size matters in M&A deals. Now, I highly encourage, and the common mistake I see is the first time or maybe the second time out, if you're acquiring businesses, do one small so you learn from a mistake that's not going to cost you the business. I've seen a PE firm who went out and did their largest acquisition first and learned on it, and that doesn't end well. Okay? So as to small businesses, remember that 50% of all transactions end up in the courtroom. Okay? So if you don't have audited statements to rely on, you're probably going to have to assume that there's a disclaimer someplace that said you as a buyer should have found it. Now, if there's fraud involved on the seller's side where he's been playing with numbers, which is a case recently that I was involved in, that's a whole new ballgame. Then you have a legal argument. But as a buyer, I would highly recommend an audit before you move forward, either from you or from the seller. Now, what you're talking about is in an audit where the numbers are messed up or they need verification, you always go back to restate by using the bank statements.
Right. I see. Now, one thing I want to clarify is a lot of people that are doing their first acquisition, they're doing it in their independent sponsor role, right? The independent sponsor role, they got a team, they're reaching out to them. So their budget is tight. So they can't go around and do audits on every business they come through. So they got to trust the numbers to a certain degree. That's where we come down to using other financial metrics to account for any overstated numbers. Now, circling back on EBITDA, and this is something I read. First of all, it is not a GAAP-approved devaluation method, and people should be wary about what's included and what's not. And I've seen brokers include items that are outside of the EBITDA realm. So taking that into consideration, small businesses account for taxes, they account for depreciation, they account for interest, and they account for amortization. So if I'm using EBITDA as my metric, I'm paying full price for depreciated assets. That's where I'm coming into the overvaluation side of things. Any comments on there? I also got a financial analysis I want to run with you, and we could look at numbers instead of just say it off the top of the head.
Yes, let's talk about Ebitda verification. Okay. One of the most important statements that is produced every month by a company that should be produced, rarely is the statement of cash flows. So if you're looking at EBITDA, you need to go to the statement of cash flows, which is the actual generated cash at the top of the statement. There's a line there. Okay. And adjust it for depreciation, interest, et cetera. And that should give you a true valuation or verification of your EBITDA number. It is, EBITDA is a US GAAP concept. I want to make sure that as a CPA, I tell you that. Adjusted EBITDA starts to get a little murky, but the verification of EBITDA can be found on the statement of cash flows and reconciling those out. Okay. Now, let me get back to your problem that you presented to me with the small business owner who doesn't have an audit. The way that that is traditionally managed is through something called either a contingency deal in the purchase agreement, whereas in the first year, if the cash doesn't end up proven up to be what they said, then you adjust the purchase price. That's probably
I like
the
that
best
approach.
way to
I
solve
like that
that.
approach.
Okay.
That's good. So, Mark, can you see my screen?
I indeed can, sir.
Okay, so this is a little financial model I came up with myself. And I want to use this deal, and this was a deal I did from one of my studies as an example. Now, the numbers are in the thousands, so we're looking at 177 million for 2018 and 208 million from 2020, right? Small businesses, I've noticed, they do not have cash flow statements. I was able to build one up. A lot of people don't know how to build them. So let's look at those. Now here in the cash flow statements, let me go to a P&L very briefly. We got revenue of 208 million, correct? Can you see it?
I indeed can, sir.
We got a total revenue of 210. And if you got any questions on how we came to these numbers, I could break it down to you, so don't worry. Gross margins of 53. Now we come down to EBITDA. EBITDA of 29 million. Let me explain how we came to EBITDA, okay? First, we added up the gross margins and divided by minus operating expenses. And the gross margin was 53 million and operating expenses was 23. The way we came up with the gross margin is total revenue minus cost of goods sold. So we're clear on that?
Yes.
Okay. So we got an EBITDA of $29.5 million. Now we come down to EBIT, which is 23 million, which was EBITDA minus depreciation and amortization. Now we got EBT, which is 20 million, which is EBIT minus interest expense plus extraordinary items. And then we come down to net income of 16 million, which is EBT minus taxes. Any comments on this?
Yeah. A couple of things. First of all, what they try to do in the valuations is the concept is whatever my ability to finance is different than the person's we're buying from. Okay. My tax situation is going to be different. So traditionally, the reason why you leave interest out and taxes out is because it's really your gain, right, to manage. Like my clients, we always try to manage taxes to zero, obviously, in a legal way.
Right.
If the seller did not have that philosophy, then that's just a synergistic thing we're going to find in our operating the entity. All right. I do want to also say that Warren Buffett obviously doesn't agree with EBITDA. He believes in EBIT. Okay. And obviously done well in life. So I'm not here to comment on that. But I just want to explain that the reason why interest and taxes are not considered in the valuation is because that's really something this buyer has to manage.
Right. What about depreciation and amortization? Because I also heard Warren Buffett say depreciation is the worst expense. Now, let me give you an example. A business could present $1 million net income, but also be negative $1 million. How? Well, they bought $1 million piece of equipment and amortized it over 10 years. So that's when they start playing and modifying these numbers. So how can we get a better idea? From EBITDA
Yes.
to net income, there's a huge difference from 29 million to 16 million.
Yeah, in our PE firm, the way we did that is we looked at CapEx needs, kept depreciation out, and inserted what is needed for CapEx to get the company to the level that we wish to operate it with.
Okay,
And then you come down to free cash flow.
Okay, now let's talk about free cash flow and those other metrics. Here's the cash flow statement. We got EBIT. Now we got NOPAT, right? How did we come up with NOPAT? EBIT minus operating taxes. Then I got this other metric, which is NOPAT minus CapEx. Same thing, NOPAT minus CapEx, self-explanatory. Then we have unlevered free cash flow. How did we come up with this? Now, we subtracted various items. We have gross cash flows as your starting point, 25 million. Then we subtract investments in working capital, which is 5 million. Then we subtract investments in other assets and liabilities, which is 3.5. Then we subtract capital expenses with depreciation and amortization, which is 13 million. Then we subtract other investments, and then we subtract extraordinary items. Now, this was an analysis on a public company. So here are expenses that private companies don't have. But we could see from $29 million EBITDA to $2.5 million unlevered free cash flow.
Okay, a couple of comments, if I may.
Yes, please.
If we're valuing public companies, there's two major differences. They're off earnings, which is where you're coming from here. Okay.
Right.
And their multiple is different because of liquidity. All right. And traditionally they're valued in a prospective way. That is not true of private companies, right? So when you're looking at comparing what the arbitrage is in the multiple for a consolidation play in an industry, for instance, okay, one of the things you're looking at is the increase in arbitrage on the multiple. Now, the other thing I see here is working capital, and I'd like to speak to that if I may.
Yes.
Because I see tremendous mistakes here in working capital in deals. So the best way let me explain the problem, and then I'll tell you the solution. The problem is that what's going to happen with the seller is that they're going to make a run on cash, right? They think that cash is theirs, and they're going to leave you in a negative working capital position. In other words, the current liabilities. Okay, so working capital is current assets minus current liabilities. If you take away a major portion of the cash, you're likely going to end up with a negative working capital. Okay?
Right.
In the transactions that I told you about that are published, they will tell you what the industry working capital standard is. And then in your deals, that number there, you would want it to be what is needed in order to keep the company viable post-transaction. That matter is settled in the purchase agreement utilizing what is called a purchase price adjustment, which is traditionally 90 or 180 days post-closing. Okay, and what that does is whatever the seller did to working capital, they're going to get an adjustment to the purchase price based on whatever the need was of the company on the standard. You with me?
Right. Yes, I'm with you. Okay, let me give you an example of a deal I've been looking at in the situation I come across. Let's say I'm looking at, there was this one deal, it was in about $2.4 million, right?
Okay.
And that was revenue, 2.4 million revenue. And it was about 748,000, give or take, net income. I was basing myself off net income on that time. The business owner, she was looking for $3 million. That was about a 4 times multiple. which it came out. It worked out well. We had a DSCR of 1.7 times. Now, one thing we do want to account for, especially taking the independent sponsor role, and we don't have a huge fund with hundreds of millions of dollars like private equity has, is having money we could pull out to use as working capital. I've noticed the purchase price changes depending on the reason to sell. What I've seen is usually there's people that want to sell for money and they want to take everything up front. And when they want to take everything up front, we got to maintain our financial metrics so it's a sound deal, which is
Correct.
a DSCR of 2 times minimum. We look at the multiples as well, see that is not above the industry standard. And then we also look at our internal rate of return. We take those 3 metrics. But as long as we're hitting those 3, that would be our offer, which is going to be less, of course. Then there's business owners who are looking to retire. And when they're looking to retire, we use a larger portion of seller finance. The reason is they don't account for capital gain taxes. And they're able to get that money over a period of time, say 7 years. And it works for them like a retirement plan, right? Plus, they capitalize on the interest. So they get more. And then there's people who are interested in expansion. And we usually have a percentage of money down payment, seller finance, and retain equity. And the retain equity is for them to liquidate as the company grows, right? So one thing I've noticed about evaluations is that we cannot take a cookie cutter approach, and we got to account for the needs or problems of the business owner, our ability to finance debt, whether it be the bank or investor, and then our metrics, meaning what's our plan to grow this company and how much cash flow are we going to have left after we're servicing everything. So I'd like you to comment on that.
Yes, sir. If I may comment on that,
Yes.
and another important metric, if I may. Earlier, you were showing revenue growth by year.
Right. I could pull that back.
I want to make sure that the audience realizes that if those those growth figures there, if those numbers are not, depending on the industry, if those are not industry acceptable growth factors, retail would be different than industrial products, for instance. But those numbers do need to be positive and growing north. Let me just speak to that quickly, if I may. Understand
Yes,
that the audience may be a seller or a buyer, right? So I have to address both sides. If everybody on the call thinks of a bell curve, the time to sell is when the slope of that bell curve is still increasing, but at a decreasing rate. In other words, you're on the left-hand side of the bell curve, but the curve's starting to flatten somewhat. Okay? As a buyer, you would only buy a transaction if you could add synergistic growth. Okay? Academically, you're trying to make sure that the company is worth more in your hands than it was in the seller. So those 2 factors are critical before going ahead with the deal if you're a buyer. Now, let me speak to the seller, if I may.
Please.
If I'm representing a seller, I would never recommend that they take back a seller note. The reason for that is the implication of that is that the company is actually worth more in the seller and the buyer's hands, right? And that's why they would go forward. So traditionally, seller notes are only a viable situation up until post-pandemic times if you were given back public stock. But I caution the audience, if they're a seller, to take back a seller note, because they're basically saying the management they're selling to is better than them. Okay. The other thing is tax laws are changing. Okay. Whatever our political persuasion is, the reality is that the debt of our country is at astronomical numbers, and we're going to have to raise taxes. So taking capital gains now, if you're in the seller seat, is going to be far worth more in value than taking a seller note. Those would be my comments back to you.
Right. Now let's look at it from the buyer perspective, which are Our whole podcast is based on the independent sponsor, the guy who wants to go out there and acquire their first business, second or third, right?
Yes.
Now, taking into consideration the reason we use seller finance, yeah, we're able to have more cash flows available on our end, but we're also able to offer them a higher purchase price because they're taking it over a period of time.
Agreed. And I think that the seller note popularity started to increase post-pandemic because the sellers are ready to get out. They've been through hard times, they're tired. So that's why we're getting away with it now. Just traditionally, it's been a tough sell.
Right. Now, I want you can you agree on this one statement? That you should never take a cookie cutter approach with valuations. Because I've been hearing people say, oh, buy on 4 times, buy on 5 times. And they're stuck to this one multiple or this one item.
Yes, can I give you a good example of that?
Yes.
The question is yes, I do agree with you. So in some industries, EBITDA is not to be used because depreciation is a critical part of the business. Let me give you an example. In the rental furniture business, you don't use EBITDA. And if you do use EBITDA, you're going to pay too much for the company. And I've seen that happen in the transaction. And ultimately that transaction went under simply because they took out depreciation when they should have left it in. So the boilerplate, let's use your term, cookie cutter approach. If you took that into that transaction, which this private equity firm did, they ended up losing millions because they didn't realize depreciation should not be taken out.
Correct. Now, the great thing about the LOI is that the LOI states that the price is subject to legal and financial due diligence. So that allows you to make corrections. Now, on our end, our process is usually we reach out to a business owner, we build rapport with them, we request financials, we go over the financials with our team, we send over an offer, and then once we got an LOI, which is something on paper, we involve the big firms. Would you say that's a good approach?
Yes, let me just tell you a couple of things about the LOI.
Sure.
There's no reason why you can't ask from the seller for audited statements at a certain level of size, right? So I would always recommend that you have that because it provides you security for your investors. And as a fund, you have an obligation to do your due diligence with your investors. So that's the first thing I want to say. As to LOI, a couple of things. One, you want to be careful that the LOI is not used for the wrong purpose if you're a seller. If you're a buyer, you want to make sure that you get away with certain things, like if the transaction doesn't go through, you incorporate a breakage fee. Because you as the buyer have already spent legal fees, you've spent staff time, etc. And you can put in the transaction a breakage fee, which is called a walkaway fee. I highly encourage that.
Right,
If you're the seller, I highly encourage, yes. If you're the seller, I highly encourage a protection of your employees because, a corporate takeover artist, what they will do is they will go in, analyze your company. The LOI is contingent upon financing. They'll bust that up and be able to go get your managers.
Right. Now, let me
As
touch
to
on
the
one.
audit,
Oh, my bad.
yes.
Sorry. Keep going.
No, that's okay. Do big firms need to be involved in doing the due diligence? It doesn't have to be a big firm, obviously. It does need to be a quality firm. What we've seen in our nation in the last 3 years is a big problem with one-person CPA firms, right? Because like in New York, they were under certain exceptions. They didn't need to get quality review controls. And so I do encourage to look at the firm as to its quality and make sure that it doesn't, it's not, quality isn't by size. It's the amount of review they do before the product leaves the door.
That's great. That was actually another question we wanted to ask. Is Big Four, Big Six necessary on a $10 million or under transaction? Now,
No.
no? Perfect. Now, let me ask you this. Can you agree that people who are accountants or experts who are usually involved in higher transaction size deals can overlook things in smaller transaction size deals?
Yes, it all boils down to the relevancy of the CPA looking at the deal and the level of review support she has after they get ready for their review release. So what happens in a CPA firm is you have a quality CPA on site, hopefully, and that person then goes to review to have a second and often third look at it, and then they go back and clear the review comments. If you're going to pick a firm, that's the type of structure you wish to see. With a one-person firm, you don't have that quality of review. You with me? And
Yes.
and there could be some issue with relevancy of new professional standards, like right now. Right now, what you guys are dealing with as buyers is the revenue recognition policy for private companies is changing this year. You have 840, that's 606. 842 is changing your leases, so it's going to, a lot of it's coming off of the income statement in EBITDA in some cases and going on to the balance sheet, which could be significant in some industries. Okay. And then you have to be concerned about ASC 810, which has to do with variable entities and consolidations. So you do need a quality person doing your look-see, if you will, doing due diligence, and that person has review.
Right. And they should be ahead of everything that's currently happening and is going to happen in the future, right?
Yes, I was, I'm familiar with a recent case where EBITDA was overstated by $12 million. That's a significant adjustment to the purchase price.
Right. That's huge.
So understand that if you buy something and pay too much for it, you're never going to recover no matter how good of an operator you are, right? So you want to make sure that the day you buy something, you've created arbitrage. What is arbitrage? The day you closed, you made money, either through your synergy, because you have better purchase discounts, whatever, but somehow you close with arbitrage or don't close.
Right. Now, using big four firms as a startup is over leveraging your company without making a dime. Would you agree?
Well, I don't want to, it's kind of like asking a doctor to make fun of another doctor, right? I want to,
All right. Yeah, you're a CPA. Right.
I don't want to beat up on my big four colleagues because I've
Right.
been there. Um, if you're saying you have to watch costs during due diligence, yes, I do agree. Is it true that big firm fees traditionally can be considered more expensive than middle-sized firms? The answer would be yes, that is true.
Okay, I've heard people say you would rather go with a boutique accounting firm, and there's actually a lot of ex Big Four working there, and you could get the same quality of service at a fraction of the price. Is that true?
I hesitate to agree with that, sir. And the reason being is the smaller the firm, the more they have to know, right? The
Right.
larger the firm, the more they're specialized.
Mm, I like that
So
point.
yes, I would caution on that one.
I like that point. Now let's talk about something that is huge, and I've seen this over and over and over. Business owners want to capitalize on the future growth of the company. And I mean, take that into consideration in the purchase price. This is my idea of it. First of all, anything in the future is a guess at best, a lie at worst. During valuations, performance are done based on historical patterns. So for a seller to say, well, we're currently doing 2 million, but we're looking to do 5 million or 10 million in the next 2 to 3 years, and they want to capitalize on that is outrageous. Would you agree?
Um, do I agree? Yes. Am I going to make it an issue? I think that, I'm a, a takeover artist, one of his goals in life is to close deals, right? It takes no talent to blow deals up. It takes a lot of talent to close them. All right.
Right.
What would I do with that statement? Which every seller CEO is going to say, right?
Everyone, yes.
So what you do with that is say, you know what? I hope you do that, and I'm going to support you with that. So let's make our deal contingent. If you get EBITDA to go from X to X plus Y, then you get this additional amount in purchase price or compensation or whatever. But do that now, we couldn't finance the deal. That would be my comment.
That's good. I like that approach. So you'd finance the transaction on what we know is a fact as of now, and they can also earn on the future if it meets those metrics, correct?
Yes, sir. And stepping away from the negotiating table a minute and talking about reality.
Yeah.
The reality is you got to finance the deal, right? And the bank's going to look at current and historic. They're not going to look at prospective because it creates a possible default.
Right. Let me ask you this. What's the use of WACC, WACC, weighted average cost of capital in small businesses?
Yeah. So weighted average cost of capital is different based on industry and size, right? So that's why, I get some, you talked about the gentleman at the PE firm who was looking at 100 deals.
Right.
If he saw weighted average of cost of capital to be X and his firm will never approve X, then he should move on and get it down to what his firm should approve. Weighted average cost of capital is an issue because that tells you, how you finance the deal post-transaction, right? And what you need to do with that. And it can be a significant deal. Back when Mike was still doing transactions, Mike Milliken and Fred, his boss, who I've done deals with, their leverage ratios were really high. So just to keep our audience with us for a moment, let's just review the facts. Debt, is very cheap. Let's use prime plus 2, less the deductibility of taxes. So it's, let's pick a number. Let's say it's 5%, 4.5% right now. Plus you get to deduct the 4.5. That's really cheap capital. So you want to lay as much as that on the enterprise as possible to get the weighted average cost of capital down.
Mark, let me circle back real quick. You said you could deduct the interest on the debt.
Yes.
How?
On your tax return.
You deduct it from the taxes of the business?
Yes, that's correct.
So you just pay principal from the cash flows, right?
Well, you pay no, I'm sorry. So you on your tax return, so you're paying to the bank principal plus interest. But
right.
The interest portion is deductible on your tax return as an expense up to a certain amount.
Okay.
So therefore, the cost of capital is prime plus 2 times 1 minus the tax rate.
What, for those that don't know, what is weighted average cost of capital?
So if you think of a balance sheet, the right-hand side of the balance sheet is how you're financing the company. Think of it that way. The further down you go on the balance sheet, the more expensive it gets. For instance, senior debt is cheap. Load it up as much as you can. We were using the example of 5% less taxes, so let's call it 4.5%.
Right.
When you get the preferred to a stable business, we're talking somewhere around 28%. It looks like it's 6 on paper, but you have to take in the conversion rate. Then when you get to common stock, you're talking somewhere between 34 to 43, depending on the risk of the business.
I see.
That weighted average of the amount of debt used times its rate, the amount of preferred times its rate, plus the common times its rate is the weighted average cost of capital.
Perfect. Discounted cash flow. Let's talk about that a minute. They say money now is worth more than money tomorrow, correct?
Correct.
So anything to the future would be discounted to its present value and it lose its amount over time, right?
That's correct.
What would the use of DCF be in regards to debt financing, or early valuations?
Okay, it's really a concept to show that the transaction is a go or a no go. It's called a hurdle rate. So every
Okay.
PE has their own hurdle rate, or every investor has their hurdle rate. Okay, so you want the discounted cash flow takes the cash flows over the life of the investment, say 5 years, and you discount it back, okay, to the current time using a discount rate. All right,
Yeah.
that amount of value compared to what you paid for it will give you your rate of return. Now, I want to tell people, and I was in a room full of CPAs, and you'll see that on my YouTube National Convention speech on M&A. The number one mistake that people make in that analysis is in the out year, they don't put the exit price. So make sure that in your discounted cash flow analysis, you put the exit price in year 5, if that's the year of hold, and then bring it back in a discounted way as well.
I see. But okay, so you're saying that's more of a part of the due diligence, but you shouldn't base your offer on it?
Well, in theory, based on market, right? The question is, should you go through with the deal based on your DCF analysis? Can you make the rate of return that the firm needs to justify its investment to its investors?
But DCF alone itself, would you make an offer on that?
Never.
Thank
It's
you.
not, it's an apple and an orange. A DCF is really for rate of return and whether you should go through with the deal or not. It's not designed to tell you what the market price of the enterprise is.
Mark, I appreciate you being on this podcast. There's too much disinformation out there. That's the reason we got started. There's too many guys who think they're experts but don't understand the numbers. We
May
got
I
an
share,
expert here. Yes,
may I,
please.
may I share my contact information, please?
Absolutely, drop that. We'll
Okay.
put it in the description too.
Okay, my cell phone is 214-929-3141, 214-929-3141. My email is mbiersmith@icloud.com. M as in Mark, Biersmith@icloud.com. I've done over 300 transactions, been a partner in a PE firm with some of the best in the world, and been a partner in a public accounting firm, which only 1% have achieved. And I've been in every chair in the C-suite. So I hope that gives integrity to your audience.
300 transactions. Let me ask you something, Mark. If somebody's done 2-3 deals, can they consider themselves an expert? If
No,
these are small little businesses? No.
no, sir. A simple phone call. You have to remember that a mistake in the acquisition is material and likely you won't recover. So it's really important that you make the purchase price and everything that follows accurate, correct, and filled with integrity so you can live to see another day.
That was great. That was great. Let me touch on that for just 1 second, Mark. Now, coming down to this information, the reason I ask these questions is to get the true insights. Because a lot of people don't understand. Buying the business is one thing. Another thing is now you're responsible and liable to anything that happens post-transaction, right?
Yes, subject to no fraud by the seller. Yes.
Right. No, I'm saying you buy a business and you did something wrong. Like the example you said, $12 million didn't go through. They didn't add this. They removed this. You're gone. You're out of the game.
You're out of the game. And let me give you a real live example. And
Please do.
this was something that was touched upon in Fortune magazine. There was a transaction that I was familiar with where there was a colleague who made a mistake on an Excel spreadsheet because they didn't put the controls in the spreadsheet when they were building it. So that got through the bank. It got through the partners in the firm. I was off doing other transactions in Hawaii at the time. And there was a mistake in the spreadsheet. In post-transaction, I got a call back to the firm on Saturday to go manage the problem. And basically, the only choice I was left with is to downsize the organization as far as its expenses, which led to the layoff of 350 people. Now that's
Wow.
just because of a mistake in a spreadsheet.
Now, let
So
me ask you, Mark, you yourself, from your experience, who would you consider to be an expert? What would their track record have to be? How many deals would they've had to done to be considered and say, I'm an expert in this topic?
I would highly recommend that the more the better, right? But what you really want to see is diversity across industries, because you end up learning what the variances are in each industry and the differences, rather than go back, to use your word, a boilerplate cookie cutter approach. An unexperienced M&A person will get caught up in that. So the more experience that the M&A person has, the less likely you're going to make a mistake, and you'll live to see another day and get the arbitrage you need.
So you're saying if I acquire three, four businesses in the construction industry, and from my experience, I'm saying, hey, this is the way you do it for a known fact. Am I being misleading?
You know, here's my philosophy on that. You never want to stop learning, right? Rules
Right.
change. We had a pandemic when none of us ever thought it would happen. The rules in accounting are changing dramatically. I don't like ever coming to a point where we're stalemating on a fixed formula to buy a company. Um, you know, I was taught once that the way you close deals is through creativity. And so give me a deal and I'll close the gap.
I love that. I love that. Let's talk about structures, business structures. There's people I want to buy stock, but they're taking into account liabilities. And there's people I just want to buy the assets. People are confused when you're doing an asset purchase. How would you value it? And we're talking about not valuing the assets itself and financing based on that, but on the cash flows. Can we still do a cash flow valuation if we're acquiring the assets without the shell?
Okay. I don't recommend stock deals. Stock deals are extremely rare. Okay. They may
Oh,
come
wow.
about, they may come about if you're selling to a public company. Okay. Because you may take back liquid stock, and then you'll have a hold period for 6 months. Okay. But stock deals are rare since the 1986, basically. I have
Since
seen them.
1986?
Yes.
Wow. So the
So
standard is assets.
the standards is assets. Now, why? Well, that means you don't have to worry about the liabilities, right? You leave those behind. And whatever the contingent liabilities may come, let's say it's a doctor's practice and you're in a state with malpractice. Well, you don't know what's going to happen in the next 7 years, right? So you want to leave all that behind. So asset
Right.
deals, tax reasons, and liability reasons are left behind. I mean, are the best way to go. Now, to your question, how do you value an asset-based business? And the answer is in the same way. It's EBITDA minus the senior debt gives you your equity, fair market value of your equity. Okay. Now, I caution you though, there is another process called the appraisal, right? That
Right.
under US GAAP, you have to have your assets post-transaction stated at the fair market value of those assets, right? So it's wise to get good at what you feel that's going to be, especially when you come to intangible values, which have different deductible lives.
Now, let me talk about asset appraisal. And this is what I heard from a bank. I asked the banker, I'm like, I'm looking to acquire this business. It's primarily going to be a cash flow based loan. I said, he said, does it have real estate? I said, no, we're not buying the real estate. We're leasing it. So I wanted to ask, in regards to collateral, would you take accounts receivable? He said, in regards to accounts receivable, it depends how old they are and how likely they are to recover, but they discounted heavily. And then I asked, what about the assets? And they said they evaluate on its liquidation price, meaning its resale value. So that's where we would deduct or take into account the depreciation, right?
Okay, let's move on the subject of academics and the reason for each type of debt. You mentioned accounts receivable.
Yes.
So there's something called a working capital facility. But if we start using working capital facility debt for another purpose, you're going to run out of working capital. Okay.
I see.
So when you do the transaction, your long-term debt should not be based on working capital facilities.
Right. We're looking at cash flow based loans.
Right.
And when we do cash flow based loans, we got to take into account the debt service coverage ratio.
That is correct. I just want to make sure though that that people understand they need to stay within the real reason of the debt that they have. Okay. So a term loan is really how you finance an acquisition, not through working capital facilities, which is what AR represents. Okay. AR, working capital, when you use AR as collateral, what you're really doing is funding the difference between when you did the service and when you get paid. For instance, in transportation, they may deliver the product but not get paid for 65 days, but they have to pay the driver upon delivery. So they need a working capital facility.
Is that the days receivable and the days payable?
Yes, sir. Traditionally, a bank is going to give you 60 days on the collateral point. As long as you don't go over 25% concentration.
Right.
In other words,
okay, let's talk about concentration. What do you mean by 25%? I understand that, but smaller businesses usually have higher concentration.
Yes, sir. And that what a bank will do is they will say, as long as we will only back up. AR is traditionally somewhere between 65 and 85% collateralized. Okay. If they find a high concentration of a customer, they will say only 25% of that receivable for that customer is subject to the 65 to 85% collateral base. The reason for that is that if something happens to that customer from the bank's perspective, they're going to be hung and you're going to go under.
Let's talk about cash flow security very quickly. Same concept, just revenue instead of AR. Now, I also heard the value of the business is its cash flow divided by its risk. And we want to take into consideration cash flow risk. A lot of people just see the bottom line and think that's it and that's what's going to be. But there's one-off things like they got a major contract or they're in the last year of a contract, right? How do we account for those items where they had a large boost of cash flow, but it's not coming in the next year? How can we make sure we're not paying for things that are not going to come back, right?
Yeah, I mean, that's one of the pandemic problems, right? Is, you had long-term receivables and that person didn't make it to the bank, didn't make it to the end.
Right.
That's why the courts down the street there are really filled in bankruptcy. That risk is really something to consider, and the banks will consider the risk based on historical collection rates.
Right. Now, I heard an accountant, another CPA say if there's a client or a customer that accounts for a large portion of the cash flow, what you could do to not discount it is have a clause on it. Essentially, and that would come down to the seller finance part of things, where you tie that seller finance amount onto that one person, and if their cash flows or they leave or whatever, we would stop paying the note. Can you touch on that?
Yes,
basically
sir.
like a insurance plan, so to speak, a liability clause.
Yes. Okay. So on the way there to answering that question, let me educate our audience to realize before they get upset with the banker that they can't lend, remember that the banker is subject to regulations. They'll do what they can do in most cases, or you certainly can find a bank, and there are ones who will do it. They will go up to the line, but at the end of the day, they can't go over the line. Okay.
Right.
So now we're talking, okay, well, what do we do with this situation that you just brought up? And the answer is you take an offset against the seller note. And that happens a lot.
I see. Let's talk about Now, when it comes down to financial metrics, usually my rule of thumb is 2 times DSCR. And I'll explain to you why. Well, it's really hard to, mess up 50% of the cash flows. So we got a 50% security. The reason we have a 50% security is because we're able to overfinance. And this is what I want to talk about. What are your thoughts on overfinancing? For example, I heard working capital loans have a 30-year amortization rate. And let's say I got $250,000 cash flows left after paying everybody. Say I want to overfinance half of it, 125. Let's just use 100,000. So I want to use 100,000 to pull out working capital. If we run it on a 10-year amortization rate, that's $1 million. What are your thoughts on that? Overfinancing such a high amount.
Okay, so you're talking about a former PE partner, and every time he hears the word overfinancing, he croaks, right? Because it affects his ROI. So, most of the time, guys, just sitting in the tower, what happens is deals are hard to justify, right? And you got to find a way to cut this cost or build this synergy or come up with some better deal here in order to get the financing to fit. It is rare that you would have the capacity to overfinance a deal. But if you could, if you're in those shoes, you would certainly put more debt on and less equity, right? Because of the cost of the capital differential that we learned earlier in this podcast.
Right. Let's talk about debt. Debt and equity. Now, for the most part, we're using banks because it does not dilute our holding equity. Private equity firms and even investors, they will take an equity share in the acquisition itself. So what are your points on that? How can we retain the most amount of equity in the transaction?
Yes. Well, most private equity deals will close with something called convertible preferred. Okay. And what they're going to do is and remember, it's all about their ROI. So what they're going to do is they're going to say, look, you're going to give us 6% annually, and then you're going to give us a certain amount of conversion rights. And those conversion rights basically will equal what they need in order to get their rate of return. But the other thing it does, which is more important to the firm, is if the managers cannot perform, then they want to grab control through the conversion.
Oh, I see. So that's how they played.
Yes,
so
sir.
as long as you're doing things well, they just receive their money and they don't get involved. If you
That's
start
right.
messing up, they take control of the deal. That's why they retain such a high percentage, right?
That is 100% correct.
That's smart if you think about it. If you're putting up all the money, why wouldn't you, right? It just
Right.
makes sense.
Yes, sir.
Great. Let me run you through a couple other questions.
Please.
And then we're going to open it up to Q&A. Guys, Q&A, just leave your questions and we'll come back to it. Now, how important it is to get a quality of earnings report? And does it have to come from a Big Four firm?
I'm not a fan of quality earnings reports, and let me tell you why. I know that they're popular, so don't get me wrong. And I know that if you only have so much money to spend in this area, that you will choose an option that gets you by. But number one, the responsibility to the person preparing the report is less than an audit. Okay? An audit gives you the highest level of security that the numbers are right and what to do if they're not. Okay?
Right.
And then you make up for that, whatever risk is left in the purchase agreement. Okay.
Right.
On a quality of earnings report, that level of security is not there. I want to make that very clear. Okay. So if you end up in a courtroom and you've made a choice of risk, the judge is going to say, well, you made that choice, that you were in charge of due diligence. Okay. So does a quality earnings report have to be done by the Big Four? No. I just went through a very good quality of earnings experience with a mid-sized firm. They did an excellent job. And, at the end of the day, the transactional price will be materially reduced.
Mark, This, if you're okay with it, would you mind sharing the name of the firm? I think people are now interested.
Know that all CPAs are great.
Right. Okay. Is it customary to make escrow at the LOI stage of a deal?
It would be nice, what you would do is escrow the breakup fee, right? You'd want the seller to do that. They may choose to get a down payment from you to show that you're serious. But what you would, in every LOI that I've ever been a part of, has so many contingencies that that's going to be cut loose. So to put up money as a buyer in escrow and have a bunch of contingencies that allows the escrow to be reduced, including financing, you liked what you saw, that kind of stuff, it's going to get reduced. But more importantly, what you want is the seller to give a breakage fee. Does that make sense?
Yes. Now I want to ask you a question that'll make you think for a minute. Maybe. I don't know. You're a professional. But it's something you could take with you. If I'm analyzing a transaction and I find out there's fraud in that business, do I have to report it? Am I liable for it if I see that there's fraud happening in the business and I don't do anything, just walk away?
So are you a buyer or are you the CPA firm?
Buyer.
Okay, because the responsibility for a CPA firm is different than a buyer, right?
Right. I mean, I receive the financials from the business owner. I analyze it with my team, and we find out there's things that, they say the IRS is what, 1 in 100 they'll analyze. So the chances of you getting audited by the IRS are pretty slim. And you understand there is money laundering and there's other things that happen, especially in smaller business size. So what would I have to do if I find something like that?
Well, you could take two approaches. I just went through something like this.
No way.
You could take two approaches. Okay, you could walk away, which is a safe approach. But if you're trying to come up with a creative way, if you knew what the fraud was and you could value the fraud, then what you would do is you say, you know what? I'm going to put in the purchase agreement, which is in every purchase agreement anyway, that the fraud, if we find fraud, we get a purchase price adjustment, and we're going to hold XYZ in escrow anyway. And probably you're going to take the amount that that the fraud affected the value, and you're going to throw that into escrow after the purchase agreement. And you're going to say, you're going to infuse convertible preferred. You're going to find the fraud. The price is going to be reduced, and your equity now says you own the company.
So even if you go through with the transaction, you're not liable, right? Because you weren't the guy who did the fraud, but you'd add that into the documents, correct?
No doubt. It's in every purchase agreement anyway.
Okay, great. Thank you. Now, accounts receivable and accounts payable. How can we negotiate those two into a PSA? And can we pledge accounts receivable to investors? And will banks consider leveraging against them?
Okay, so all working capital accounts, which would be cash, AR, AP, current liabilities, current assets, everything above those lines should be put, and I really caution your audience to make sure they understand this. That should be put in the purchase price adjustment to be cleared in 90 to 180 days. Because you need that working capital ratio to be in the business for it to survive without additional financing. Okay? Now, can it be collateralized? Yes, AR is, but once again, it's designed to fill the gap. So it won't solve the PPA problem. So you want to leave that in. Did that answer your question?
Yes. I want to touch on red flags. What are major red flags to look for? Now, to not make you think hard, I made it easier for you. I came up with my own chart that we go through red flags, and I want to see what is, Here, let me share my Excel very briefly, and I want to see what to look for, what not, and if you'd add anything or remove something. Okay, can you see my screen?
It's coming up.
You let me know, Mark.
I see it now.
Okay. First thing I want to ask you is annualization. It's very
Yes.
simple. You get
Yeah.
your data divided by the amount of months, multiply times 12. When would you say it's risky to annualize a number and make an offer on? How many months? A
It's
quarter or
always
less? Is always risky?
it's always risky, but it's especially risky to an uneducated buyer who's buying a seasonal business.
Seasonal. Key point there. Assets versus liabilities. Now, we were told that if you get the total current assets and divide it by the total current liabilities, you'd get a score. So anything under 1 means it's a red flag. There's more liabilities than assets, meaning that if we'd have a liquidation occur where we got to pay our debts, we would have less assets than debts to cover it. And anything over 1 is great. It's like a DSCR, so to speak. It means the liquidation arises, you could cover it. Comments on that?
Yes, sir. Every industry has a different, that one, okay, is the academic answer. Traditionally, that number ranges from 0.8 to 1.2. All right. But there are industries in which that number is significantly different depending on the nature of the industry itself. So this is one of those areas where you need to be an educated buyer and understand what the industry working capital ratio is, which can be found in that listing of transactions we talked at the beginning of the podcast.
Right, but that is something you look for to determine the strength of the business, correct?
No doubt about it. Yes.
Okay. Now, another thing is I wanted to include total assets by total liabilities, and I added the past 3 years, current to past. Reason is I want to see, has assets been increasing while liabilities decreasing or the same, or has liabilities been increasing while assets have been decreasing? Is that something you look at?
Yes, sir. But we have to be more cautious because US GAAP now does a lot more fair market value accounting. So it could be that the assets are going up simply because of fair market value, where the liabilities are usually stated at cost. So the answer is it's a good analysis, but you want to make sure it's a good analysis for the right reason.
Great. Now, something major that basically will make or break your ability to finance a transaction commercially is what's the taxable income to the profit and loss stated income. Meaning, and we've seen deals like this where the seller says, we made $2 million, and they report that in the net income. They report that in the taxable income, and then net income is higher or lower. But we see a difference between them. We say a difference of 15% or more is usually a red flag, and that won't fund. What's your comments on that?
Well, there are significant reasons why the two numbers, I always like to use the Al Capone approach. They say that Al Capone got busted because he had two sets of books. Well, the reality is every company has one, right? Every company has two
Right.
sets. They have a book and they have US GAAP. There are significant reasons in the tax code right now as to why taxable income could be materially different than P&L net income. For instance, if you have a high fixed asset enterprise, you're going to have a lot of bonus depreciation. So I just want to say it is a great analysis. Once again, it has to be analyzed once you get the variances.
I see.
And
One
you'll
major reason I've
find-
seen the difference is because business owners want to report less money earned on the taxes, so they don't get taxed as much, or on the P&L.
Yes, sir. That is a great two things. Number one, as to my last comment, there is a place on the tax return that reconciles those numbers. But to your point, a sole owner of a company has the specific objective of reducing taxable income, right? So,
Right.
yeah, so oftentimes taxable income is understated if all you were doing is transferring it over to the new buyer.
I see. Now they say line 21 is where usually you get the number. Are there any other lines I want to look at in the tax return?
It used to be called Schedule M.
Schedule M.
Mhm.
I see. Now the other thing is receivables to payables. I added this one in. I don't know if it gives me, this is part not only of red flags but financial strength. Accounts payable is a service that has been rendered and we gotta pay. And accounts receivable is a service we've rendered, and our customers have to pay. Now, I want to see: do we owe more? Do we got to pay more money than what's coming in? Would you consider that a red flag or something to take into consideration?
It's definitely a concern, but there could be valid reasons for it, right? And if the working capital ratio, it's, I would be real, if I saw a big difference there, I'd look at the working capital ratio. Because it could be that receivables aren't coming in for a while, but you owe the money today. I gave the example of a transportation company
Right.
where they pay the drivers today and they don't get paid for 60 days. So it's definitely something to take a look at. And the difference, what that would lead you to is go take a look at the working capital ratio.
Okay, I see. Now I added this, and it's basically the year-on-year growth percentage and the percentage of revenues for total other income, expense, net other income, net income. And the purpose of this is I want to see during the years what's its volatility and how
Yes.
much does it account for revenue. I saw a
Agreed.
deal where numbers were jumping up from 20% last year to 80% the next year, so on and so forth. When is it a red flag? Because I've noticed banks like steady growth and not all over the place, either growth or loss, right?
Well, I think it's a red flag if the ratio of gross profit to revenues is decreasing, or total expenses are increasing, or net ordinary income is decreasing. Anytime it's going the wrong way, it's cause for concern, right?
Right, right. But also in regards to growth, um, would you say major growth from one year to
Yeah, you
another?
would like to see an increase in gross margin as revenues go up, implying,
Gross margin.
right? And then you want to, ideally, you'd like to see your total expense be going down as a percent of revenue, implying that you've gone over the fixed cost hurdle and everything becomes variable.
Right. Now, I've noticed companies that usually resell products like retail tend to have lower profit margins than companies that offer services or their own products. We look at a standard of 20% minimum profit margins as essentially we have to make less sales to account for more money. Would that be a reasonable number?
Yeah, I think so. I'll just add a comment rather than, retail deals are very difficult to finance just in the equity markets. I'll just mention that. E-commerce now is much easier, but traditionally in the past, retail deals have been considered very risky.
I see. Thank you very much.
Mhm.
Now, let me ask you, what are the most important things you look for when analyzing a balance sheet and profit and loss statement?
Accuracy, integrity, and completeness. Because if you're looking at numbers that aren't accurate, complete, or lack integrity, you're going to come to a different conclusion than what the facts may have represented. If you look at the wrong, in logic, philosophy of logic, we talk about if you have the wrong premise, you risk the wrong conclusion. The best way for a business person to reach the right conclusion is to have the right facts in front of them, which means the P&L is accurate, complete, and contains integrity.
I see. Now, sorry, give me a second.
While you're taking that second, let me add to that.
Yes.
If I'm a CEO, the one thing I would always ask from my CFO or controller is don't deliver me a financial statement for the month if it's only the income statement and the balance sheet. Because the statement of cash flow is called the interactive statement. So there are things you find when you prepare the statement of cash flows that when you prepare the income statement and balance sheet, you may not have been aware of. So as a CEO or a buyer, you always want to make sure you're seeing all three statements.
Perfect. Now let me add that. Let me add to that. How many years of data do you need for you to make an accurate representation? I've seen people say, "Oh, just with the last year, you can make your offer."
Okay, the academic answer to that is when you go through a recession, I don't know, let's say it's a pandemic, something that's critical in a year. Traditionally, you take the average 5 years to come up with the valuation to eliminate the risk of its repeat. So I like 5 years if I'm a buyer, so I can have negotiating strength going in. If I'm a seller, I'm probably only going to give 2 years, which is I'm going to meet the regulations as to comparative financial statements.
So the regulation states 2 years, right?
If you're the SEC, you have 3 years of financials to show.
Mm,
In most comparative statements for private entities, they have 2 years.
I see. So meeting at the middle between 5 and 2, would you say 3 is a good place to make an LOI on?
Unless there's been a recession or some other major economic event that you can utilize to your favor to eliminate risk by including that in the average Ebitda to determine the valuation.
Great. Now, let me ask you one last question, Mark. Appreciate your time. You've been, more than helpful. Let me touch on shelf companies. Now, from what I heard, when you buy the assets, you would move those assets to a new entity, right? That entity, because it's new, it is considered a startup. I heard somebody told us the best way to approach that, because banks ask for 3 years tax returns, is to buy a shelf company that's been reporting taxes for 3 years or more and move the assets onto that company. Would you say that's a strategy to approach that?
I not only because I'm in Dallas, but I guess Mark Cuban would I don't keep him out of it for a moment. I believe in doing things in business for the right reasons, and playing games like that concern me, because does it hide the true value of the business? Because that's why you're doing it. If there's something you're doing to affect the market multiple, I'm probably more likely to say, okay, I understand. In other words, go into a publicly traded company already and get them, get the higher multiple off your contribution of assets. But I'm just not a fan of playing tricks like that. That's just me, though. There are players that would play that game.
Right. Then what's the best approach if a new entity would consider a startup and we need 3 years?
You would have to put contingencies in there. If it's a startup enterprise, there's a lot of risk, right? Which means the cost of equity is going to be very high.
Right.
So traditionally, what you would do is you'd put contingencies either in the equity price or in the purchase agreement, that if you don't hit the numbers, this is what's going to happen.
I see. Makes sense.
The other risk that usually investors take to mitigate that risk is they'll have what is called a pull down. So they'll say, look, I'll commit $10 million to you, but I'm going to give it to you at $1 million when you accomplish this. I'll give you another $1 million if you hit this performance, that kind of thing.
I see. Well, I appreciate it, Mark. Any comments or questions, Nancy, you got?
No, I've enjoyed being a part of this, and you'll find a backup to what we learned today on YouTube with my national convention speech. I'd like to re-establish my contact here at the end of the talk. Once again, my cell is 214-929-3141, and my email is msmark, B as in boy, I as in it, E as in Edward, R as in Robert, SMITH at iCloud.com. And I have enjoyed being with you tonight, and I thank you.
Thank you, Mark. Very briefly, let me touch with Ansi. Ansi, you're good?
Yeah, man, I'm good. I'm good. Really appreciate you having the time to shine some light on a lot of this misconception that's out here in the M&A community, Mark. I really appreciate it, and I also really look forward to you working on the deals that me and you briefly touched on last week. So really, really looking forward to working with you and appreciate you doing this.
Thank you both. I appreciate it.
Mark, you're the man. I wanted to ask you, can I put your LinkedIn profile link on the description?
Yes, please.
Perfect. Thank you very much. Take care.
Thanks. Bye-bye.
Bye. Guys, thank you very much for being a part of this episode. Great episode number 12. And as you know, we're the only ones pushing this level of information out there. And you heard it from the man himself, 300 deals. You cannot claim to be an expert if you've done 2, 3, 4, 5. Get out of here. Stop being a joke. Peace.